Got a bunch of Fed speakers, Joe, we're trying to get through today as well, looking ahead to earnings at the end of the week. The real test is going to be, can stocks withstand a period of higher interest rates again?
Well, we've been going through a period of higher interest rates since May 4th. Two-year Treasury is up 140 basis points in less than a little more than 60 days. So I think the market has already absorbed a significant move in yields. I think now the challenge is a lot of long duration strategies were being suggested. It was return, extend the duration once again. And I think those positions are being squeezed out. A lot of that's being reflected in mega cap technology underperforming today. And I think today is more about an equal weighted strategy, Scott. Having mean reversion.
Alphabet, Amazon, Microsoft, they're all weaker today, to your point.
It's not so much where I'd say, okay, it's technology universally, because if you look at the software ETF, the IGV, that's up 1.25%. If you look at the SMH, that's up 1%. So I think this is concentrated towards mega caps, the equal weight strategy. But you're right. If we're going to continue to see yields rise, long duration strategies, which we talked so much about at the beginning of 2022, you don't really want to extend duration in that environment.
You know, Weiss, it's an interesting point. I mean, maybe tech is the perfect place to look to see if there's going to be a rollover of any kind if you do have rates, you know, continuing to creep up. There's some notes out today that are talking about that in part from a number of different places. Bernstein's Tony Sacconaghi, by the way, says we struggle to recommend an overweight in tech for the second half. Believe stock picking increasingly matters. Probably you agree with that, right?
Yeah, I do agree with it. But, you know, look, I think the biggest vulnerability is in the large cap tech, because that's where, on one hand, price vulnerability, because that's where the action's been, right? And that's where the major instances of multiple expansion have occurred. Less so. There's less. This sounds kind of strange, but that it sounds kind of strange because they have the best balance sheets. They have the best growth outlook. If you take a look at, for example, what earnings forecasts are, earnings forecasts for this quarter look to be down 7%. But there are two sectors where it's really looking to be up, and that is in technology. So the strange thing is, though, they're vulnerable because of price, but not vulnerable to the fundamentals. So those are the concerns. So, yeah, if the market rolls over, that's going to be very painful for a lot of people.
Well, that's interesting, though, the way you bring that up. They're vulnerable because of price,
right?
Not necessarily for the fundamentals, which is why even as Citi today downgrades U.S. stocks, in part because they think that technology is due for a potential pullback, they'd be buyers on the dip. For the very reason that you're suggesting, because they provide all of the things you suggested, and the fundamentals line up as well. So maybe the price is a little ahead of itself in some of these names. You get a little bit of a correct there, if that even happens.
Right.
And then you're going to get buyers on the dip.
Right. And this is a binary week, right? I mean, forget about the Fed talk. You've got inflation numbers, and if inflation numbers show a real decline, then the market's going to take off. If the numbers, on the other hand, show, like we saw in, I think it was in Europe today, show an uptick, then you've got an issue with the market. So so it's binary based on them. What you're seeing today is really nervousness in that very leadership group that you're talking about.
The question is, Bryn, as to whether, you know, if tech falters, is something going to be there to pick up the slack? Barclays doesn't necessarily think so. They don't believe that broadening is going to happen to the rest of the market. The other idea that Bank of America puts forth today on the issue of rising yields, since 1980, they say peaks in U.S. two-year yields have always been followed by a risk-off event within the next year or so. The full extent of damage is unknown until the peak in policy tightening is behind us. We are clearly not at that point yet. How do you see this?
Well, I mean, I think first of all that you can clearly have other sectors lead when tech is faltering. We saw that last year. If you actually didn't own tech, you did quite well. And so you can always have those opportunities where other sectors carry the weight. Last year is a good example of that. I think right now it's about digestion, and that, yes, we've had massive multiple expansion. And outside of NVIDIA, I'm really hard pressed to see which companies in the tech side are really raising guidance. Sure, Facebook is cutting expenses, but who's actually raising guidance outside of NVIDIA? So I do think this will be one of the more important earnings seasons for tech companies.